Hi everyone, Chapter 2, the financial statement auditing environment. So this chapter, that's what we're focusing on. Specifically, we'll be looking at the learning objectives on page 36 of your book, and I didn't get my glasses out before I started recording, so just give me one moment to find them and we'll get going on there they are, on our lecture. So, before we start talking about the types of auditors, we will be familiar with different types of auditors. That's our first objective. Then we'll be looking at the various forms of audit, attest, and assurance services offered by accounting professionals. We're going to understand the organization of public accounting firms and how an audit team is formed, the significant changes that have taken place in the auditing profession over the past decade, management's primary responsibility for the financial statements. We'll recognize that an audit is shaped by the business, industry, and economic environment of the company being audited. We'll be familiar with 5-component model of business processes used to organize an audit. We're going to identify and be familiar with the major organizations that affect public accounting profession's environment. So all these things are part of the audit environment. Look at auditing standards and the 10 generally accepted auditing standards, the nature of auditing standards, and the profession, their emphasis on ethical behavior and how it is governed. So quite a bit of information in this chapter. So let's start with types of auditors. First of all, your external auditors are your certified public accountants who are independent of their audit clients and provide an opinion on the financial statements of the company. It is only certified public accountants who have the authority to provide an opinion on an company's financial statements, and they have to be independent. So that is your external auditor, CPA firms. Internal auditors. They are governed by the Institute of Internal Auditors. You could become a certified internal auditor, but these are employees of the company who are auditing the company. So they do not have independence from the company. And their main objective is to help the organization achieve its objectives by bringing a systematic, disciplined approach to evaluate and improve risk management, control, and the governance process. So they're there making sure what the company says it's doing it. Governmental auditors are part of, that's the GAO, Governance Accountability Office, and the IRS. The Governance Accountability Office audits the federal government, and it answers to Congress. The IRS, the Internal Revenue Service, audits tax returns of individuals and organizations, and it's part of the Department of Treasury. Now, there are other components, but those are the main governmental auditors. And then finally, there's forensic auditors. And forensic auditors are mainly employed to detect fraud, construct incomplete or damaged records, probe money laundering, fraud, and investigate more fraud, embezzlement. So there's some specific items listed on page 40. Usually people become certified as a fraud examiner. There's over 75,000 members in the Association of Certified Fraud Examiners. So that's another type of auditor. Also, a forensic auditor will be used as an expert witness because they're normally investigating criminal activity. So they may be asked to be part of a trial and be selected as an expert witness. So those are the different types of auditors. What are the different types of audit, attest, and assurance services? Well, the different types of audit services, there's internal control audits, and these are usually done and must be done for public companies. And we'll talk more about why. But a public company must have them. A private public company being one traded on a stock exchange, must have them done. Private companies may have them done. There's compliance audits, and that's just auditing to make sure a rule is being followed. Are you complying with a certain rule? There's operational audits where a process may be looked at, and this is where you'll identify the problems of that process and provide some suggestions as to how to improve it. And then there's forensic audits, which detect fraud. So those are your basic audit services. Attest services report on the nature, is an example. An attest service will just an auditor may provide numerous types of attest services regarding a particular subject matter. For instance, reporting on nature and quantity of inventory stored in a company's warehouse so that the company can obtain a bank loan. So the auditor will attest that that inventory is there. They'll assert. Assurance. Auditing is a specialized form of assurance services. Now, this is important because assurance does not mean 100% correct. An assurance is that it's assuring or suggesting that you can rely on. They feel confident. Okay, so auditing is not a perfect 100%. We found no errors at all in any of the company's accounting information. No, it is a art of assuring that the financial statements are in pretty good shape. They could be relied upon to make decisions, but it's not a foolproof 100%. You can count on these, but we feel pretty confident. And also there's non-audit services, tax preparation, management advisory services. So that's where the company is providing assistance to the company, maybe in their HR function or their finance function. Compilation and review services. Now, a compilation is basically a preparation of a financial statement. Review services are more of it's more than preparing a financial statement, and it's an examination of the financial statement, but it's not to the extent of an audit. So it doesn't provide as much assurance on relying on the financial statements as an audit does. But these are other activities that CPAs do perform. This is explained in detail in Chapter 21. We just want to give you a flavor for this now. So there's different types of audit services, different types of test services, assurance services, and then non-audit services. Now, the next objective wants to talk about, Objective 3, the different types of public accounting firms, and that's who is performing audits. So there's international accounting firms, PricewaterhouseCoopers, Ernst & Young, Deloitte, KPMG. Then there's mid-tier. They might be more, they're more of United States, Grant Thornton, BDO, RSM, McGladrey. Then there's regional, and there's a whole bunch of those. Locally, there is like Snyder and Clemente. They are more than one or two people in the company, but they're not statewide. They might have several locations in an area. And then there's local. This is your very small company, CPA firm. It may be one location, a few accountants. So we have all these different public accounting firms, from a single proprietor to thousands of owners or partners. Audit teams are developed within these organizations. Now, every audit team member has a specific duty. So the partner is the one that is in charge. They are the ones who reach the agreement with the auditee, the company. They ensure that the audit is properly planned and that the audit is conducted in accordance with auditing standards. They create the audit team and make sure they have the required skills and experience. They'll supervise them and review the work done by the team. And then they'll conclude on the adequacy of audit evidence and actually sign the audit report. So every partner in a CPA firm must be a CPA. A manager is the next level down from a partner. Their tasks are on the audit team is to ensure that the audit is properly planned, and they schedule the team. They supervise the preparation and approving the audit program, the steps the team will take. They review all the work collected, the financial statements, and audit report developed by the team. They bill the client and make sure the company gets the money. And then they tell the partner about any auditing or accounting problems encountered. So the partner is kind of like that CEO of the company. They're overseeing everything that's happening in the company, and they're involved with the audit, but at the upper end of it. They are like the final sign-off. The manager is the person down that's doing all of the supervising of the team itself. The senior assists the manager in developing the audit plan. They prepare budgets. They assign the tasks to the associates and direct the day-to-day performance of the audit. So they're on the site making sure the job is getting done. They review the work of the associates and inform the manager about any auditing or accounting problems. And then finally, the staff or associate. That's usually the person just coming out of college. That's where you start. You perform the audit procedures assigned, prepare adequate and appropriate documentation of all the work you completed, and inform the senior about any auditing or accounting problems. Okay, so that's the normal track of a public accountant who audits. They start as a staff, they go to a senior, then a manager, and then ultimately to partner. But they all have specific duties on the audit team. All right. Now, right now in our auditing world, we have a time of challenge. You see, 1990 to 2000 is on our timeline there. So during the boom of the late 1990s, economic boom was occurring in early 2000s. Accounting firms became aggressive, and they sought opportunities to make money on high margin non-audit services. You could only charge so much for an audit. So accounting firms don't make a lot of money on audits, but they can make a lot of money on management services, consulting, and non-audit services to the companies that they audit. Well, because of that relationship and those close ties to how much money the accounting firms were making off of their audit companies, there was a explosion of accounting scandals. So a company such as Enron might have said, we want to report our liabilities this way. And the auditor, who was Arthur Andersen, thought, no, we better not. But they were afraid that if they went that route, they would lose the couple $1 million in non-audit services they're providing to the Enron of the world. So to protect that other revenue coming in from non-audit services, they went along with it. And in the end, there were many corporate scandals. Brokerage firms were involved, corporate giants, the stock exchanges, mutual fund managers, public accounting firms. Everybody got in trouble. And there was a lot of accounting fraud occurring. So, and oh, by the way, that accounting fraud affected the stock market significantly. So, and you can read all about that in your book. In response to this, Congress passed Sarbanes-Oxley, which Sarbanes-Oxley Public Company Accounting Reform and Investors Protection Act, but we just usually call it SOX. And then in 2010, they passed another law, the Dodd-Frank Wall Street Reform and Consumer Protection Act. Now, before I go into the society's expectations and auditors' responsibilities, let's just think about that slide we were just viewing. Sarbanes-Oxley is an act that really affects public company audits. It requires public companies to now have not only financial statement but internal control audits. The Public Company Accounting Oversight Board, which is a nonprofit agency, was developed, and it's really like a quasi-government agency that creates auditing standards for auditors who audit public companies. It requires companies to rotate their auditors, their auditing firms. Okay, so a lot of things changed with that. The Dodd-Frank Reform Act expanded audit law to foreign audit companies performing work in the United States. So the government, Congress, got very involved in auditors' business, in plain English, especially if they're auditing public companies. Now we're going to talk about, what if I don't audit a public company? What if I audit a company that's privately owned? Well, we have the rules for that too. But for now, let's go to this society's expectations and the auditor's responsibilities. We need to know as auditors that we plan and perform an audit to obtain reasonable assurance, not absolute assurance, but reasonable, about whether the financial statements are free of a material misstatement, whether caused by fraud or error. So some are intentional, some are not. But we try to conduct an audit to detect those kind of things. And if we create our audit program correctly, we should. So, but we're just providing reasonable assurance because we're not looking at everything. We don't have time to. And the audit client doesn't have the money to pay us to do that. Society, though, thinks that we will find fraud as an auditor. Oh, you had that audited. You should collect information that you will find all fraud. If it's a small fraud, we probably won't, because we're not looking at small things. We're looking at material things. Or if we do stumble upon them, it's by accident. Most fraud is detected by someone blowing a whistle. It's never found in an audit. So because of the nature of audit evidence and the characteristics of fraud, the auditor is able to obtain reasonable but not absolute assurance that material misstatements are detected. So as you're going through the chapters, you're going to realize, geez, I'm just sampling. I'm not looking at everything. I'm picking out maybe high dollar items and making sure everything's, the way it should be with those, but I'm not looking at little things. So we're not detecting fraud. We're just making sure that the financial statements are not materially wrong. So when we are developing an audit and taking on a company, the primary context with which an auditor is concerned is, what is this industry or business my company is in that I'm about to audit? You need to understand that. You need to be an expert, even as an auditor. So this is a primary component of the environment, because you're auditing financial statements in an industry or business. For instance, when you're thinking about inventory, would they differ from a salmon farm in Alaska versus an MBA team? And the answer is in your book, and they would, because of the nature of the industry both operate in. So we have to look at a model of business, and there's a great model on page 47. Business organizations exist to create value for stakeholders. Who are the stakeholders? Primarily the stockholders, the customers, the employees. Okay, So due to the way those assets, these resources that a company gets are invested and managed in a modern business world, we need corporate governance. We need to watch the company. Managers are overseen and supervised. And how does this occur? Well, it occurs through the board of directors, which is elected by the stockholders. Remember, the owners are giving the company money. And once that company gets their money, they're out, unless they're also a manager in the company. But not all stockholders are working at the company or doing anything with the company. Most owners, like sole proprietors or partners, are in control of the investment they made into the company, but stockholders are not. So they elect a group of individuals to oversee the company, make sure the company is using their resources properly, and that's the board of directors. And there's the audit committee as well. The audit committee is a subset of the board, and it makes sure and watches and hires the internal and external auditing work. And then the internal and external auditors report back to the audit committee. So there's an independence there even from the company. The audit committee is part of the board of directors. The board of directors is overseeing those managers and people who run the company day to day. You got to remember something. Managers who run the company day to day, although we like to think they're doing everything in the best way for the company, they're not. They're going to do it so that it's in their best interest. So if they've got to, incorrectly report something so that they get their bonus, chances are they probably will, especially if they think they're not going to get caught. So that's why we need these audits, and we need to count on the board of directors to look out for the rights of the owners, and we need that audit committee. So within a company, we have, in the model of business, we have the company's objectives. So what are the objectives of the company? And it's with the guidance from the board of directors and management, they decide this. What are we here for? The strategies are how we're going to accomplish that. How do we achieve these objectives? The processes are the things we use to do that, to do the how. Controls, and we're going to talk about those in a little bit. Controls are what is in place to protect the company, protect the assets, especially. Transactions, we know our business activity within our accounting system that we use to produce reports. And so that's what we're focusing on in auditing. What are the overall objectives? What are the strategies? What are the processes the company uses to get those strategies accomplished? What kind of controls are in place to protect the company and to make sure they're achieving their objectives? How are their transactions recorded and reported? So the 5 components of that business process that we just talked about. The financing process. How does a company make money? Do they sell stock? Do they have loans? How do they pay it back? What is that whole process? Then we'll look at the purchasing process. How do they purchase items to support operations? How do they pay for stuff? The human resource management process. What are the components of human resources? How do they hire employees? How do they fire them? How do they evaluate them? That needs to be looked at because that's part of the process to achieve that business model. Inventory management. Now that depends on the type of business you're auditing, but if you are auditing a manufacturer, a wholesaler, retailer, you are interested in the inventory process. How do they buy? How do they make their inventory, depending if they're a manufacturer or just a merchandiser? And then the revenue process. How do they generate revenue? Through the sales of their goods or services. How do they get the money from them? So these are all the typical type of questions we're answering about all of these processes, and they're part of the business model because it's these processes that achieve the strategies and then the objectives of the business. So that's kind of the overview of auditing. That's what we're looking at, that business. So an overview, once again, there it is. That's what it looks like in a pretty graph type of presentation. Okay, you'll see we have the management and board of directors up here. They're developing business objectives and strategies, the defined business processes to achieve those, performance measurement and assessment, and then how do we report the transactions. So we show you that so that you know as an auditor, that's what you're focusing on, to get an understanding of that. Now we're going to switch gears. So that's part of your audit environment. What else is part of your audit environment? Well, it's just the regulators out there that are looking at the public accounting profession. You've probably heard of the SEC, Securities and Exchange Commission. They were formed in an act in 1933 and 34 in response to the stock market crash and ill accounting, not proper oversight of the accounting profession, not proper oversight of public companies. So now this agency is part of the federal government, and they are policing public companies. They are in charge of making accounting rules. Now, they don't make the accounting rules, but they oversee the process of it. And public companies are required to report, as of now, information on a quarterly and annual basis. A 10Q is for quarterly, 10K is the annual report. Part of that annual report is an audited financial statement from an accounting firm. So they're one organization. Another organization is the Public Company Accounting Oversight Board. Remember, they were formed in response to the Sarbanes-Oxley. They oversee auditors who audit public companies, and they make auditing standards for those auditors. Financial Accounting Standards Board is another organization that affects our environment. They are the detail writers of current GAAP. So they are currently the organization in the United States that is making new accounting rules. They make the details of them. The SEC gives them the stamp of approval. The American Institute of Certified Public Accountants, which is the national organization of certified public accountants, they are of course part of, they are very important in the accounting profession, but right now are making auditing standards. They are part of the auditing standards for auditors who don't audit public companies, so private company auditors. They also are in charge of our ethical and professional standards, and that's about it for them. International Auditing and Assurance Standards Board. So this is your international auditing group that is writing standards for international auditing and overseeing that process. And then, of course, the International Accounting Standards Board. They affect our audit environment because they are writing the international accounting standards. So if you are an auditor in the United States auditing an international company, you're following international auditing standards and international accounting standards. So they're different than financial accounting standards. We know that. International, everybody else in the world. Financial accounting standards, us in the United States, US. So lots of different organizations, guys, all involved in auditors' business, right? And accountants' business. But it is necessary, and we need to be familiar with who is overseeing what. And that's why we need to introduce you to all those groups, and you should get a good feel for who they are. Now, auditing standards, what are they? They are guidelines for and measure the quality of the auditor's performance. So they're telling us how we should be conducting ourselves as auditors and giving us guidelines to auditing. Now, Auditing Standards Board, and let me just double check something. I'm sorry, just give me 2 seconds. Okay, they are the organization where the Auditing Standards Board, AICPA, is the organization where the Auditing Standards Board is housed. They make auditing standards for non-public company audits. The PCAOB is making auditing standards for public company auditors. And then the IAASB are making auditing standards for all those international audits. So in the United States, we have 2 major standards boards. Now, let's talk about some of the standards then. On the bottom of, and say I could bring your attention to the bottom of page 53, the Accounting Standards Board first issued what are known as the 10 Generally Accepted Auditing Standards many moons ago, back in 1947. And they've modified them to reflect the changes in our environment over the years. But the Public Company Accounting Oversight Board said, these are pretty good auditing standards, so we're going to adopt the same standards right now. And then we'll add our own standards as we go. So there's the good news. Whether you are a private company auditor or a public company auditor, you're following 10 standards that are the same. And they relate to general standards, the standards of fieldwork, so that's your collection of your audit information, and then the standards of reporting and how you should present yourself and how you should complete your work during those phases. So we're going to take a look at each one of them. Your general standards, you should, the audit should be performed by person or persons having adequate training and understanding as an auditor. So you have to make sure anybody on your audit team has that kind of technical training and proficiency. What's very important, we'll talk about this later, is that in all matters to the assignment, so anyone involved in the assignment, they're independent from the company they are auditing. And those are very specific qualifications. So we will talk about what is independence. And due professional care must be exercised in the performance of the audit and the preparation of the report. So those are your general standards. You've got to make sure people know what they're doing, how to audit. They have to be independent with regards to the company they're auditing, and they have to use professional care. Now, during the audit, that's when the field work is occurring. Standards of field work. The work is to be planned and assisted and supervised. So, you have to have a plan in place, and you have to have people who supervise that process. A sufficient understanding of internal controls must be obtained to plan the audit and determine what other tests must be completed. So you got to understand, what kind of procedures does the company have in place to protect the assets of the company? Do they count the cash drawer twice? Does the clerk collect the cash, count it, and take it to the bank? If that's the case, is that good internal control? Or does the clerk collect the money, counts the money with the manager at the end of the day, they both agree to it, and then the manager takes the money to the bank? So we want to make sure we understand what the company is doing. And then we want to, beyond that, once we assess how good their internal controls are, now we got to make sure we get enough other evidence through inspection, observations, inquiries, and confirmations so that we could afford a reasonable basis for an opinion about the financial statement. So we're collecting evidence during field work, examining internal controls, and that's part of the plan and supervision of the audit. The last are the standards of reporting. First is GAAP, and it's basically saying the report, so our actual audit report will state whether the financial statements are presented in accordance with GAAP, meaning the financial statements follow generally accepted accounting principles. They're not doing their own thing. There's consistency. The report shall identify circumstances in which principles have not been consistently observed in the current or preceding periods. Disclosures. Informative disclosures in the financial statements are to be regarded as reasonably adequate unless otherwise stated in the report. And then opinion. We must give an opinion, express an opinion regarding the financial statements taken as a whole. So that's our job. That's our final job as an auditor. We got to give a report. They're either reasonably assured that you're in pretty good shape materially. The financial statements look pretty good. It's different language than that, but just to bring it down to street level. Or there's an assertion to the effect an opinion cannot be expressed. And it goes on to say in our Exhibit 2-2, when an overall opinion cannot be expressed, you need to state why as an auditor. Usually we don't come to that. Usually we have some kind of an agreement. If there's issues found during an audit and we bring them to management and we're able to change them and change the financial statements, we will do that. But management doesn't always want to change. So we need to say in our audit report, hey, they're not doing this correctly. Okay, so we're going to talk about those different kind of audit reports. But that's what allows us to do that. All of these standards, general, fieldwork, and reporting. Okay, so again, this was the exhibit I was just reading to you. This is the Public Company Accounting Oversight Boards. They adopted the same one as the Accounting Standards Board. Accounting Standards Board private auditors, PCAOB public auditors. And I'm not going to read them again. Okay. So again, the Accounting Standards Board tells us there's a purpose to complete an audit. It's to express opinion on the financial statements prepared by management, whose responsibility is to prepare those financial statements and provide the auditor with information so they conduct their audit. Auditors' responsibilities: they must have competence and capability, be ethical, maintain professional skepticism and professional judgment. How do they perform their audit? They're going to look at internal control. They're going to collect enough evidence so that they can make an opinion. I know I skipped over that last one, but you could take a read through it. It's pretty straightforward there. And I'm going to read it to you from my own. So if I go back, I got to re-record everything, and I'm not going to, because the reporting requirement says you express an opinion in the form of a written report based on all the evidence you collected. So we're doing the same thing in both models. GAS and SAS are considered to be the minimum standards of performance. The PCAOB, Public Company Accounting Oversight Board, adopted GAS and SAS. GAS, General Audit, don't mind me, I'm having a brain moment here. And you guys are going, I know exactly what it is. It's right there. So just give me a second when you have a moment where you're like, I forget what the generally accepted auditing standards. Thank you. The PCAOB has adopted generally accepted auditing standards, and the standard account auditing standards existing in 2003 and modifies that existing body by issuing standards called auditing standards, AS. So when you see an AS, that is an auditing standard that has been created by the PCAOB. If you see an AU, that is the Auditing Standards Board acronym for auditing standards they create. Statement on auditing standards are classified by two numbering systems, SAS and AU. The SAS number applies to the order in which the standards are issued and are thus chronological. Okay. The AU, though, is codified, meaning they're organized. They organize those SASs according to topical content, which is probably easier for research purposes because everything about one subject area is in that area. Where the chronological listing is, you need to know when a particular item passed in order to be able to access it. So these standards are out there for people to read, and they're in two different versions. So SAS number 39, audit sampling, is found under AU 350 because the AU 300s relate to the standards of fieldwork on evidence collection and evaluation. So there's your general principles and responsibilities are the AU 200s. Audit evidence AU 500. 300s and 400s are risk assessment and response to assess risk. We're going to be talking about these items in detail. That's your book. Using the work of others can be found under category 600. Audit conclusions and reporting 700. There's your guidance. And then special considerations are 800s and 900s. So that's a much nicer codification than 1, 2, 3, 4, 5. But people are used to certain ways, so they left them in both arrangements. Okay, and then finally in our chapter, and it always comes back to this, they talk about ethics, independence, and the code of professional conduct. What is ethics? Well, ethics is a system or code of conduct based on moral duties and obligations that indicate how well and how we should behave. Okay. So we have an ethical code in accounting, and it is a standard setting by the AICPA. This is under page 57. The AICPA's Code of Professional Conduct for Auditors. And we have a Code of Professional Conduct. It provides us the acceptable behaviors for auditors. Rules, principles, and interpretations are also provided. It applies to all auditors, whether you're auditing private companies or public companies. Now, professionalism is a little different. It refers to the conduct, aims, or qualities that characterize a profession or professional person. And all professions operate under some type of code of ethics or code of conduct. In the United States, as a CPA, you have a very strict professional code of conduct. One being, we just don't talk about our clients. We're not required by law to be confidential, but by our code of professional conduct, which is very interesting. Lawyers and doctors cannot talk about their clients by law. Accountants can by law, but don't because of our ethics and our code of conduct. And we live to that. So that's just one of the typical type of codes, the ethical codes that you'll find. There's listing of them. The AICPA has them on their website, aicpa.org. See if there's anything else I want to say about that. And yeah, Chapter 19, we'll talk about this in more detail. Because as part of our ethical code, we got to make sure we're independent, and it's very important you understand what makes an auditor independent from the company they are auditing. Okay, so that is where we're going to end our discussion for Chapter 2. All of these items affect our auditing environment. Once again, just a quick review. We looked at the different types of auditors, the different types of audit attest assurance services accountants will provide, how public accounting firms are organized, and the members of an audit team and their various functions, the regulatory agencies that are around the auditor and the auditor, what rules they're following. We looked at how an auditor has to look at a business model, understand the objectives and strategies, processes, how transactions are recorded and reported in an industry that they're auditing. They have to understand what auditing standards they need to follow and what the auditing standards are, whether they're privately auditing or publicly auditing, who makes those auditing standards, and then understand their professional code of conduct. Okay, so we are done with Chapter 2. You can post any questions you may have to the discussion board about this material, and go ahead to your quiz and assignments.